What is Dakota Research? It's a brand new user interface focused on helping due diligence analysts manage the enormous amount of information around private funds, new funds in the market, funds currently fundraising, all the Form D information around funds, Form ADV around fund of funds. There's so much information. We've built in CRM-like capabilities so you can enter in all the investments that you've made and you can follow those. That means anytime there's a change to that fund or that firm or portfolio manager leaves, you get an alert at 5 o'clock each day. You can enter all your investments, all your call notes, you can enter your proprietary contacts, you can enter anything you want, just like a normal CRM. Then you can run reports. You can run existing investment reports, and then you can run prospective investment reports because you can create opportunities against the funds that we have in the database. And if for some reason we don't have a fund in the database, you can add one. So it's basically a tool that allows you to manage the enormity of this information, of which we're doing 99% of the work, and we're just giving you a place to go view that information, read the information, and then enter your own information against that. You can enter contacts, you can enter accounts, you can enter funds, most of which we're already going to have. And then what we do in the background is attach all this additional information to those funds as time goes on. When there's news, when there's events that happen, it gets attached. So we're doing all that in the background for you. Then you can use this as the place where you view, track private fund information. As I said, new funds that are being formed, first closes, final closes, all that type of information without having to lift a finger or enter anything. The only thing you enter is you create opportunities, you can enter your call notes and your contacts. So if you want to book a demo, go to dakota.com and you can book a demo. It's an unbelievable platform. It'll save you so much time, and it also allow you to uncover new investment opportunities. Go check it out.
Hello, everyone, and welcome back to the Dakota Research podcast. You'll notice a smaller group here at the desk today. Chris, unfortunately, feeling a little under the weather, so you have myself and Alex. We are pumped to bring you this episode. As ever, I'll run through the agenda quickly. We'll touch on some private equity news and trends, and then we'll get into our deep dive topic discussion. We're very excited about the topic today. Today's topic is sports investing in sports. Who are the key players? Burgeoning asset class with a ton of new things happening every single day. It seems like as we're recording this, just this week alone, we have Champions League, the players is right around the corner. We have big UFC fights coming up. Obviously, football season just ended, but March Madness is right on the cusp. And then the NBA season is full of drama. Kyrie Irving just tore his ACL last night. That's what a shame. Huge. If you're already a broken-hearted Mavericks fan, I'm sure that's not helping even if anymore. Then finally, we'll wrap it up with our upcoming events and show notes. For everyone listening in, put your questions right into the chat box. We will be answering them throughout the show, and we're very excited to be bringing you some news today. So let's just jump right into it. There's some news about another one of the private credit ETFs that's just launched.
Yeah, this plays nicely into what we spoke about a few weeks ago on evergreen funds and interval funds. Again, it doesn't mimic that structure exactly, but it's still a liquid alternative to an alternative asset class. So State Street is partnering with Apollo, and they're launching a private credit ETF. This one was interesting, probably one of the more popular headlines that came out last week. So it is a private credit ETF that is managed by State Street. But what's interesting about this strategy is that Apollo is the one providing the loans, and they're selling them to State Street, and they're also buying them back from State Street. So they're the ones providing the liquidity. There's some concerns from the SEC and others, and there's a lot of controversy. I'm still frankly learning about it. Technically, ETFs are only allowed to own illiquid investments up to 15%. This one, because Apollo is the one providing liquidity, it's ranging anywhere from 10 to 35%. What's weird about this strategy is after it was announced last week, the SEC has been coming back and saying, there's some controversy around this. We need to do a little bit more due diligence, which usually isn't the case. They usually vet all of the stuff before the fund being launched, but it's an interesting one to track. This isn't the first time a private credit ETF has really existed. There's sort of bank loan ETFs and ETFs that hold CLOs and things like that.
Bond blocks and all of these firms that are doing them.
Yeah, so it's interesting to see if State Street is going to seek pricing from other firms outside of Apollo, if there is a daily limit to Apollo buying back these loans. There's a lot of questions around liquidity as well, so definitely one to track that will keep you guys updated on as well to see how it develops. But it's a first of its kind, and it's going to be interesting to track.
Yeah, wow, very exciting. We'll move up to Canada here for this next piece that came across on the news last week. Mackenzie Northleaf, the global private equity fund, has opened up to accredited investors. So Mackenzie Investments, and everyone's probably familiar with them, Canadian investment management firm, and then Canadian private markets investor Northleaf have joined together to establish a fund called, as I mentioned, the Mackenzie Northleaf Global Private Equity Fund. And that is now open for accredited investors to access through their retirement savings plans, retirement income accounts, education savings plans, tax-free savings accounts, and first home savings accounts. Really interesting. We talked about that actually on an earlier episode as well, just with private fund managers wanting to get access to retirement funds. So it's obviously happening already in Canada. Maybe that'll be a trend of something that we'll keep seeing with these large firms.
Yeah, true. I mean, if you think about everyone here, whether they work for a big corporation, they have a 401k plan, there's a very concrete menu of items. They tend to just be stock or bond ETFs or mutual funds. So again, the private markets haven't previously tapped into this pool of wealth. So I expect this to continue in a big way.
Yeah. And the way they're described too on the offerings, I feel like it's always just like aggressive or traditional or conservative. Now, like, will you one day be able to have access to like, hey, I want to put my whole retirement into tech or into energy transition, like we spoke about, like getting more, creativity.
Yeah, I mean, anecdotally, my previous firm, it was an investment firm, so there were tailored products that had multiple ETFs or mutual funds into one thing that you could just put all of your money into. Yeah. Also, you could invest directly into our firm's mutual funds in the 401k plan. But yeah, I could see the offerings for someone in a retirement plan to have a lot more optionality.
Yeah.
Not only across sectors, but private and public asset classes.
Well, cool. Speaking of private and public asset classes, we'll get over here to our fundraising highlights segment. Neuberger Berman, you've heard of them, no doubt, if you're listening in. They've raised over $1 billion for their commingled real estate secondary opportunities fund. So that is Neuberger Real Estate Secondary Opportunities Fund 2, closed with just over $1 billion in capital commitments. It was an $800 million target, so they shattered that. And the predecessor, which is the first vintage of that strategy, raised $712 million. So very successful. We have a handful of the investors here, just coming from the Dakota Research and Dakota Marketplace data. Looks like they scored $519 million from institutional investors, including corporate and public pension plans, to name just one that we called out, Houston Police Officer Pension System, who committed roughly $50 million to the fund. So nice ticket size there. The fund is targeting investments in mature real estate funds through partnerships with firms seeking liquidity and aims to recapitalize seasoned real estate funds and investments into collaboration with incumbent third-party managers, focusing on the U.S. and Europe. Again, just really interesting, right? We talked a lot a few weeks ago about secondaries and how it started in private equity with what used to be these like graveyard funds, and now it's become an attractive asset class.
Yeah.
And now to see it, moving to real estate secondaries.
Yeah, no, it's a unique opportunity for investors because these assets, they're already cash flowing. So if you were to buy a secondary interest in a real estate asset, you're immediately going to be getting yield from that. So that mitigates that J-curve effect, which is pretty huge. Also, too, not only secondaries more broadly are growing, real estate secondaries more specifically is probably the most nascent of all the asset classes. So a stat that I found earlier today, of all real estate assets, around 2% are secondary assets versus buyout, which is closer to 7%. So there's a ton of runway for funds like this to proliferate.
Yeah, and before you get to the next one, I just saw, just while we're on this topic, I just saw on LinkedIn just about an hour ago, as we're recording this, that Hamilton Lane just launched their secondary evergreen fund. So just more and more in the secondary.
Oh yeah, it's going to be popping up all the time now.
Yeah. Again, that is as live of news as we can get. But looks like something else happening in the energy transition space.
So yeah, Blackstone, they closed their fourth energy transition fund. It's a private equity style investment vehicle. They hit their hard cap at $5.6 billion. Minnesota State Board of Investments was one of the larger LPs in the strategy. They allocated just north of $1 billion. This is really interesting. Blackstone's energy transition platforms over $23 billion at this point, and definitely touches on some points that we made last week on infrastructure. Again, this isn't a pure infrastructure investment fund. I'm sure some of their holdings are involved in energy transition infrastructure, but they are investing across all sorts of companies that are providing the solutions to get from sort of a brown to green energy environment. So a couple to call out: a glass insulator manufacturer, Sediver, a backup power management solutions provider, TriStar, an energy technology and infrastructure company, Lancium, and some other providers of green energy and solutions around that supply chain as well. So $5.6 billion is a massive fund.
Wow.
You can see these LPs are interested in the energy transition and how much opportunity there is there. Not only is the world looking to move away from fossil fuels slowly but surely, but also clean energy is becoming a little bit more price attractive as well.
Yeah.
It's not as expensive as it used to be 10, 15 years ago.
Yeah. Makes a ton of sense. Speaking of expensive, we'll jump to our deal segment now. People are putting money to work, to say the least. So first we'll start, actually locally here in our backyard. Aquiline, they are a private investment firm that specializes on financial services and technology. And SCI, you've no doubt heard of them right here in our backyard. They have entered an agreement where Aquiline will be acquiring SCI's family office services business. Following the transaction's close, the business will operate as Archway, capitalizing on the well-known and respected brand of Archway within the family office market. Everyone, I'm sure, if you cover family offices, you've heard of Archway, or if you are a family office, I guess I should say too. SCI's family office services business delivers technology and outsourced services that connect and power the accounting, investment management, and reporting functions of a family office and the intermediaries. Archway is designed to streamline family office operations and deliver advanced financial reporting for ultra-high net worth families. SCI's family office services had $723 billion in the Archway platform at the end of 2024. So that is a huge win for Aquiline.
Yeah, if you look at where Aquiline specializes, it is squarely in these types of services. They're financial services and technology investors. So if you look at the list of their portfolio companies, it's a lot of fintech companies, a lot of fund admin companies that are in the investment supply chain. So this investment fits squarely in their portfolio. They have the operating expertise, they have the network. So this is a perfect investment for them. Makes a ton of sense. And we'll sort of grow that Aquiline platform much more.
I love it.
Another acquisition we want to speak to, not necessarily a private equity sponsor-backed transaction, but a company buying another company. Nokia, the Finnish company, they were just approved to acquire Infinera. This was announced in June of 2024, but just was unconditionally approved by the EU last week. So this acquisition brings together two innovation leaders with a history of industry first. So with this acquisition, it creates essentially an optical networks powerhouse with the scale to accelerate product roadmaps, further expanding Nokia's ability to help network operators unlock opportunities and sort of reach those demands of the AI era. The main benefit for Nokia here is for them to tap into the North American markets where their competitors like Huawei haven't really had success doing. Infinera is based out in California. So that's going to help them expand and meet that demand in North American markets. And the solutions that Infinera offers, it's going to allow Nokia to provide those like AI infrastructure solutions to the Googles and the Microsofts of the world. So again, like the previous transaction we spoke to, this one makes a ton of sense. See Nokia's market share expand a ton over the next months and years.
Yeah, maybe they'll one day get back to indestructible cell phones.
Yeah, sure.
Moving right along, though, People Moves, Schroders Capital Solutions, they've named a new CIO. So they've appointed Vikram Bahandari to the newly created role of Head and Chief Investment Officer of Schroders Capital Solutions. He will be leading their private market solution strategy and execution, and his job is to help drive business growth of the 77 billion euro, roughly 97 billion US private markets business of Schroders. A very exciting role. He'll be based in London, report to the global head of business development and product.
Yeah, Schroders Capital. Everyone knows the larger platform of Schroders, but Schroders Capital specifically focusing on providing tailored solutions for their investment clients on private markets more specifically. So they're looking to take that to the next level, making a pretty strategic hire and providing their clients with a lot more expertise and knowledge around investing in this private markets, which, it's why we're here in the first place talking about this stuff.
That's why we're here. MassMutual had some news too. We're just in Boston earlier this week for Dakota Cocktails event, and we hopefully got to see some folks from there.
Yeah, for sure. So MassMutual, they announced a new advisor's head. So this is Joe Malley. He's going to be heading the financial advisory business, succeeding John Vaccaro, who will be retiring after 20 years with the firm.
Wow.
John has served as CEO and general agent of MassMutual Eastern PA, which is an agency within MassMutual. In his new role, his really main focus is to sort of grow the reach and productivity of all the financial professionals in the MassMutual network. So look to see that platform grow over the next, few years.
Yeah. Best of luck. Look forward to connecting with Joe. Cool. Let's move right along to the next segment here, which will be our sports investing.
Really excited to talk about sports investing. We're actually going to cut to a couple interview clips where Chris Leroy, who again, unfortunately couldn't make it today, speaks to the Rain Group, who are major players in the sports investing world. So really excited to have you guys tune into that. So let's just set the stage here and sort of talk about sports investing and how it's evolved so much, even just over the last 5 years. So roughly 5 or so years ago, the North American sports leagues that we know and love, the NBA, the NFL, the NHL, have changed ownership significantly. There's a lot more instances now of these private equity investors coming in and taking minority or majority stakes in these businesses. Before they were probably owned by families for 20, 30 years plus, and now the ownership landscape is starting to change a little bit. So this is why this type of asset class is becoming a lot more popular. Just to put some numbers behind the growth here, the global professional sports market is projected to grow from a little over $500 billion in 2024 to $630 billion by the end of 2028, which is a 5.6% CAGR. So some of the key drivers, again, which we'll allude to later, media rights expansion, sports technology advancements, and sort of the growing live event space as well. What's unique about sports and as an investment is their diversification to other more traditional investments and their stability. If you think about the structure of sports investments, very low correlation with stock and bonds and sort of private equity, traditional private equity and private credit. They're also very recession resilient. If the market's doing well, the market's doing bad, people's fan loyalty are extremely strong. They're going to continue to consume sports, watch sports, go to live events, buy tickets, buy merchandise. So that makes it an appealing investment when the market is on shaky grounds.
Yeah.
So we're actually going to pass it now to Chris and the Rain Group, where they're going to talk about sort of the overview of the sports investing landscape.
Colin, I'd like to dive into Rain's sports practice. You've been involved in a number of iconic sports transactions, including the sale of Chelsea Football Club and UFC to Endeavor. What common themes are you seeing across the sports leagues today?
It's a great question. I would say every transaction and situation is unique. So you can't really look at them all with the same lens. I would say there are a couple of consistent themes though across leagues where fan bases are
aging and the demographic is getting older. And as Eric highlighted, challenges with cord cutting makes it harder for leagues to really know where their fans are. So you're seeing a lot of attention turned to how do we grab fans at younger ages? How do we understand the customer, know who the customer is, identify the data that the customer produces, and really establish a longer term relationship. So, it was very easy 25 years ago when if you were a fan of a specific team or a sport, you really either went to the game in person or tuned into one of the major broadcast networks to watch it. Today, a lot of different ways to do that, to consume content. Younger generation of fans aren't sitting in front of a TV for 4 hours. So really understanding that new generation of fan, what do they want? How do they deliver content in a way that they will consume and digest it, talk about it, potentially bet on it? These are the sort of the new challenges facing sports leagues, at least domestically. And then I would say you've seen some of the big major leagues in the U.S. really look to overseas to expand their fan base. So, what the NBA has done in Asia, what the NFL has done in the last couple of years with identifying markets overseas for teams to build audience and following is really a global product now. And you're competing in a global entertainment marketplace, not just sports. So you're competing with all sorts of forms of content. So I would say thinking bigger and internationally and younger in terms of fan bases is certainly a priority.
Great. It was great to hear from them. We'll hear from Rain Group more in just a few moments, but first a little bit from us. So just some key players in sports investing that we want to call out. So as Alex mentioned and Chris and Rain Group have gone through now, really a growing asset class. More and more firms feel like they're doing it now. So just to call out a few private equity firms, you have Arctos. Feels like they were one of the shepherds for this. You have CVC, Ares, Clear Lake Capital, Sixth Street, a lot of the big names that back in 2019, there was a group that it needed to be approved. I think that might still be the case, which I'm sure we'll go into, but not just any firm can invest in sports teams. The league has to approve different firms, which is interesting. And then institutional investors and family offices, many high-profile family offices and pension funds have started allocating capital to sports assets. What's interesting there, I'm actually reading a book right now called The Club about the history of the Premier League. Oh, nice. And that's long been going on in Europe, particularly with the EPL. This has long been going on. So when you just think about family wealth and pension funds getting involved in these assets, nothing new internationally, but new for us here in the U.S. So something we definitely want to follow. And then just some major sports deals to call out and just how big is this and how rampant is it? So according to iCapital, 71 major North American sports teams that are collectively valued at $205 billion now have private equity backing. That's crazy. 71 is, that's probably 2.5 full leagues. And then women's sports, obviously there's been a ton of growth in that. You have the Caitlin Clark effect that's been going on. Women's sports have been valued at $145 billion in 2023. They're also drawing significant investment interest. And then it's also, something just to call out, notable investments that we want to call out here. Angel City FC was invested by Bob Iger and Willow Bay, CEO of Disney, of course. Bay FC invested in Sixth Street. And then FC Como Women receiving investments from Avenue Capital Group and Mercury 13.
Yeah, no, a couple of things I want to highlight there. 71 sports teams valued at 205. I mean, that's a lot, but that's still 71 is probably less than a half or maybe even a third of all North American sports teams. So 205 billion is still just a fraction of what the total TAM is in this investment space, which is crazy. And then women's sports too is growing massively as well. And it's a trickle down effect, right? There's such an investment in women's sports at the youth and high school levels. And now that is starting to creep into college and professional. And I think we're going to see more Caitlin Clarks in not only basketball, but soccer and other sports as well.
Yeah, absolutely. And we'll just move right along to, some trends in sports investing as well. So we talked about media rights, obviously with the, great streaming evolution that we're still feels like we're going through, but definitely have gone through. Live sports continue to be the crown jewel of media rights. So global media rights revenue is expected to reach $62.4 billion in 2024, with continued growth driven by demand for live content. The NBA has a $76 billion media rights deal with ESPN, ABC, NBCU, and Amazon, and just continuing to grow. And notably, the NBA is even down in ratings pretty dramatically compared to past years, and they're still pulling in that type of number, which is just out of control.
Yeah, there's just a ton of movement here. If you think about Netflix, for example, they're dipping their toe into broadcasting live sports, which is something they've never done before. The Jake Paul, Mike Tyson fight was the first live streaming event Netflix has ever done.
Yeah.
I mean, there were so many people dialed into that it broke down the servers for some people, including myself. I struggled to watch that one a little bit.
I struggled too, but because I didn't try to watch that one.
There you go. This weekend, I watched a boxing fight on Amazon. Amazon's doing live sports as well, pay-per-view events. So these streaming companies, media companies outside of the traditional, ESPNs of the world are wanting to get involved because it's such a lucrative space.
Yeah, there's some challenges in streaming growth as well. It's just like you were just sort of alluding to there, the subscription businesses, sort of have kind of disrupted the traditional media rights, like the NBC, or I guess NBC is Peacock, but the ESPNs and the ABCs now having to compete with Disney Plus and Hulu, and right, you were just talking about Netflix, but in my crazy year was the Christmas Day NFL games on Netflix this year. I think
they were. Yeah, they had a couple,
which is out of control. And you've got Ravens Steelers on Netflix. That's something.
Yeah, 100%.
Talk to me about some major deals that have happened, Alex.
Yeah, so you mentioned them earlier. Arctos, they're probably the main player in the sports investing landscape, particularly on owning actual teams and owning stakes in teams. There's the sports investing landscape, obviously. It covers multiple areas, owning sports, but also sports tech, wearables, things like that. But Arctos has made some significant investments in professional teams that I'm sure everyone has heard of. There's been some major team sales as well, even over just the last, recent time. Chelsea FC, one of the, major players in the EPL, they sold for over $3 billion, and the Denver Broncos for $4.6 billion.
Yeah, it's great. You have to wonder, I'm not asking you for an answer, just sort of speaking out loud, but you have to wonder about the liquidity issues, right? Like, who do you sell a $3 billion asset to?
Yeah, someone with a big checkbook.
Yeah.
That is willing to, hold that investment for 15, 20, 25 years.
Yeah.
And, other sort of outside of sports team investing is, again, I alluded to the sports technology, so we'll touch on it a little bit. But FanDuel and DraftKings, these sports betting apps have been a huge tailwind for the industry as a whole. We're actually going to, again, turn to Chris and the Rain Group, where they're going to talk about their DraftKings deal.
We talked a little bit about sports betting, and Rain's investment in DraftKings is solid through the early stages to becoming a public company. What was Rain's strategic role in guiding DraftKings, and how did you see the sports betting space evolving when you first underwrote that investment?
When we first underwrote the investment in 2014, sports legalized online sports betting was not a thing in the U.S. at least. So it was a daily fantasy sports business. I remember we had an appendix page in our investment memo that said, here's what this business could look like if sports betting is legalized in the U.S., but it was really not something that we underwrote. It was more of a upside opportunity for the company. I would say we were heavily involved in that company on the board. We helped them a variety of ways, but formally through our advisory business, we helped raise several rounds of capital for the company, made introductions to our network of sports teams and owners and leagues who eventually became shareholders in the business. We actually advised the company on their acquisition of SB Tech in partnership with Diamond Eagle, making the company public, in 2021. So we had a pretty outsized role in that company, sort of an extension really of the management team in many ways. And where do we see it going? I would say the market in the U.S. is bigger than we anticipated and probably the company anticipated. Not all states are legal today. Just the current live states are growing year over year pretty substantially. And when additional states legalize, that will only grow the market. It's heavily concentrated amongst a handful of players, and we expect that trend to continue as scale, brand, product innovation really matters in this space. So we expect to be a few winners, and DraftKings certainly to be one of them.
Well, cool. That's a little bit on DraftKings from someone that isn't Kevin Hart, because I can't turn on the TV without seeing the Kevin Hart DraftKings commercials. Let's go into the emerging segments. So youth, college, and sports betting. We obviously just talked a little bit about sports betting.
Yep.
Let's dive deeper into maybe youth and college sports.
Sure. Yeah, no, we talked about it a little bit before with sort of the growth in women's sports, but the investment in youth and college sports, institutional investors are getting involved in youth and college sports, particularly through the likes of Unrivaled Sports, invested, through Josh Harris and David Blitzer, and League Apps, which was an Arctos and sort of SL KKR investment. And then obviously the NIL deals that have been coming out recently with the NCAA rule changes over the last few years with name, image, and likeness. That market is already valued at close to $9 billion, and that's going to continue to grow immensely now that these companies have access to these college players and tapping into their likeness and image. So that is a huge tailwind and a growth driver. And then another one is, again, we just heard about it from Rain, sports betting and fan engagement, thinking about how can the industry get loyalty from fans outside of just, growing up in Philadelphia and being an Eagles fan. When people are betting on sports, they have skin in the game, they are glued to the TV, it gets them watching sports, maybe teams that they've never watched or heard of before. So this is just like an extra way for sports to be sticky in households through sports betting. So FanDuel is a big platform as well outside of DraftKings. They're held by KKR and Shamrock. SimpleBet is another one, which was acquired by DraftKings, and then Splash Sports, another platform owned by Elysium Park Ventures and some other VC firms. So sports betting, as it sort of legalizes more and more across different states, that part of the business is going to be a huge driver for not only sports tech, but sports investing more broadly.
Yeah, there's a ton of technology and innovation happening too when you just think about like the future of fan engagement, right? And for myself, obviously I've taken a hard break since I unfortunately am a Sixers fan, but I've been a long time NBA fan, and you have, you can create like a My NBA, right? There's a little QR code on the screen, you get like interactivity to a certain level with the game, right? You can follow along on your phone, you can see all sorts of things, merch, all of this. So just seeing more and more of this. The U.S. sports technology market is growing at 20.8% and estimated to reach $114 billion by 2034, which is crazy. Key investment areas, one I sort of just mentioned, would be AI-driven fan personalization. That's when you think the NBA and having the QR codes, being able to interact on your phone and get different like AI recommendations for things. AR and VR enhanced viewing experiences. That's interesting. I can see a world where you're watching a UFC fight, maybe Alex Pereira, and you're in the ring. That could be pretty cool. And then data analytics for team performance and sponsorship invites. People love that. I think when you think of baseball, for example, like it's such an analytic-driven game, and sort of the money ballification of all other sports. And now getting that not only in the hands of the people making the decisions for the team, but also in the hands of the people who are rooting for the team at home.
Yeah, 100%. I mean, PJ Tour's doing that right now. Sort of the Aon Insights, where you're watching, hole 14 at TPC Sawgrass. You can see across the whole weekend, okay, if a drive goes into the right rough, their chances of making birdie or go down by whatever percent. I think it's really cool to interact with the data as you're experiencing a game or an event live.
Yeah. My drives are always going into the right rough, but Rain Group, they're stroking it right down the middle. So let's hear from them on emerging opportunities.
We've had some success in investing in emerging sports leagues. It's one area where we think there's still substantial upside, both domestically and abroad. So we're focusing on that area. In addition, women's sports has grown rapidly over the last 3 to 4 years. We expect that trend to continue. And then there are a lot of enabling technologies that support the ecosystem of sports that we're focused on. In addition to, as Eric said, international opportunity. So from a market penetration and growth standpoint, a lot of the major U.S. sports are relatively mature, but you're still in inning one or two in many markets overseas. And so the commercialization of content, of IP, of sport is really at its infancy. So we think there's a lot of outsized returns looking outside the U.S.
Great. Now we'll move over to other monetization strategies. So we just talked a little bit about technology and innovation. We heard from Rain Group on what they see as emerging opportunities. But media rights and broadcasting, we've talked about it, obviously. Media rights remain the largest revenue driver for teams, as we mentioned. Ticket sales, VIP experiences, and game day revenue. This one's really exciting. Everything from luxury seating to corporate sponsorships, in-stadium experiences, and more. And obviously, there's a ton of creativity that companies and investors can get there. I think of Formula One, where they'll have the Porsche suite, and then it's like you get all this stuff if you go here, and you get this whole different experience if you go here, and it's partnered by this brand, and it's all that. The U.S. Open does something similar. Yeah. And then sponsorships and licensing, that's kind of what I was just mentioning, but naming rights, not only just naming rights historically, like the actual stadiums, M&T Bank, Citizens Bank Park, the Lincoln Financial Center, of course. I was blanking on that one. It's one I can't forget. Jersey sponsorships, though, brand partnerships, always increasing. So I'm sure more and more.
If you think about how many eyeballs are watching these marquee events, even just a small piece of real estate on a jersey or a helmet, it's a billboard, but a live billboard that you can guarantee that millions of people are watching. So that is really important real estate and dollar signs for the sports teams.
Yeah, with jerseys, I mean, millions of people are watching it, but also millions of people are buying them. So then next thing you know, if you have your brand on the Ravens jersey, then everyone in Baltimore walking around wearing a Lamar Jackson jersey is also representing your brand.
Yep. So we think about long-term value creation in sports investing. I think there's a couple key areas here to focus on. So just thinking on like the franchise as a whole, so the Philadelphia Eagles, the New England Patriots, what have you, how they're appreciating in value, it's pretty immense. So the Ross Arctos Sports Franchise Index, they measure how franchises appreciate in value over time, and they've demonstrated historically very high returns with pretty low volatility relative to traditional private equity or public investment, which is really interesting. And then when you think about the expansion of U.S. sports internationally, right? Eagles home opener in Brazil, they're playing in Europe every year. The growth of North American sports across the globe it's always kind of been there over the last 10, 20 years, but growing a lot more significantly now because that's just an untapped market. There's always been interest there, but now getting boots on the ground, having games, live events there is going to really attract more of those eyeballs outside of the United States.
Yeah. I just found a fun fact recently, adjacent to this topic, but on the international expansion, the NFL was doing some games in Mexico City. Apparently they had to stop doing that because of how the altitude in Mexico City was affecting the players. You don't think of Mexico City as being a very high city, but it's actually higher altitude than Denver. Just something.
Yeah, I was going to say.
Interesting fun fact.
Yeah, they don't have too many issues at Mile High Stadium. I don't even think it's called Mile High Stadium anymore. I don't really know.
Yeah, no clue. But Mexico City higher than Denver.
There you go. Learn something new every day. And then again, we talked about it earlier, but the growth of women's sports, right? That's half the market are women. So it makes a ton of sense for these firms and investors that are involved in sports to grow that market because that's 50% of the market that has previously been underserved. So it makes total sense for them to grow that area to access more people that can come to events, spend money, watch and consume women's sports. So
yeah. Alex, is sports a core portfolio allocation?
It depends on who you ask, but I think slowly it will as this market develops a little bit more and there's more buyers and more sellers and the liquidity profile maybe improves a little bit. Again, it's not probably one of the more illiquid things that you can buy. Yeah, I could totally see it given the profile. Again, it's very recession resilient, uncorrelated to traditional investments, which I think more and more people are seeking. So maybe not right now, but in due time, it's very possible. And we just think about like what's next in sports. We alluded to it multiple times, but think about like AI and tech and sort of the innovation in sports, wearing VR headsets or data and providing that to consumers of sports, media experiences, like all of these things that are going on in the sports tech world. How is that going to impact viewership, eyeballs, live attendance, things like that? It's going to be very interesting to track. Athlete-owned content platforms, sports betting markets. Again, those are huge tailwinds for the industry as well. And I guess to round it out, what are some key investor considerations? So I think a couple questions that have been posed and will be main areas to think about as we progress. How will leagues balance revenue maximization with fan accessibility, right? I think about the Super Bowl, for example. Some of those ticket prices are egregious, but there's demand there. But you also want to make the live experience, you want the viewing experience to be accessible to everybody. So how do you manage that? Again, you want to grow top line revenue, but you also want to expand access to everybody. Data-driven sponsorships, can they ensure sustainable revenue growth? And then, technology redefining the sports industry. Is it really going to change how we consume sports forever, or is it being a little overvalued and a little overhyped? These are all considerations that someone would need to make if they're going to make an investment in sort of the sports realm.
Yeah, I love it. I'll just call out this fund to watch out for. We saw a recent fund launch last week, actually, as we're recording this. CAZ, C-A-Z, all caps. CAZ Professional Sports Ownership 3 launched last week, third vintage of their sports fund. This one is interesting. You get, it's 50% NFL focused, 50% other sports, but the investor does have the option to allocate to a 100% NFL sleeve. And then that lower barrier to entry is an interesting component too, with only $100,000 minimum. So, obviously I was talking about how with some of these assets, it's pretty, daunting sizes, right? Chelsea was $3 billion. The Denver Broncos, hardly a marquee NFL team, in my opinion.
Yeah, there's some feeder vehicles around some of these sports funds, but if you're investing directly right through an Arctos or another one of these players, like the minimums are probably a little higher than like a traditional PE fund. But yeah, 100K minimum. I think CAZ is an allocator that has like a GP stakes business, and they've been getting involved with the sports investments. So
maybe we'll have them on the pod sometime.
Sure, yeah, we'd love them.
Great. That will wrap up the sports segment for today. Let us know if you have any questions. We're happy to go deeper into this. We would do another episode on sports for sure with Chris, or even with another expert. So if you're listening in and want to come on and talk either from a fund manager perspective, or if you've allocated to sports in the past and you want to come on as an expert allocator, we'd love to have you. In the meantime, though, we will just go ahead and think of a sports transition. We'll go ahead and alley-oop it over to you, Alex, where we'll do a funds in the market segment.
Sure. So, yeah, one firm to call out who is in the market is Obvious Ventures. They're raising hopefully $400 million for their fifth fund. They have yet to open for subscription, but stay tuned there. Their previous fund, the fourth vintage, closed at $355 million in 2022. So they're looking to exceed that and push the firm's AUM over that $1 billion threshold. So the firm's based in San Francisco, impact focus venture investments. So kind of targeting three areas: human health, planetary health, and economic health. They've made some notable investments in previous funds, one being Beyond Meat, Nectar, Mosaic, WorkPop, Dino Therapeutics, to name a few. The co-founder of the firm was actually a co-founder of Twitter and Medium. So clearly has experience being an operator and a founder. So we'll provide some value add there outside of just writing checks to these companies. So if you're interested in the impact space and investing in the venture arena, this might be a firm to check out.
Yeah, and Brookfield, we always talk about Brookfield on the other podcast that we host, the Fundraising News podcast, but Brookfield Asset Management is targeting $7 billion for its fourth infrastructure debt fund. That is the Berkshire Infrastructure Debt Fund 4. They got real creative with that name, but great firm, great fund. The Global Alternative Investment Manager filed this with the SEC on December 30th, 2024. So they got it in just in time for champagne on New Year's Eve. And so far, Maine Public Employees Retirement System is among a group of institutional investors that have partnered with them on this fund. Maine PERS put in $100 million, so quite the ticket size. I was actually just drinking Poland spring water today. The newest addition to their debt fund strategy will succeed the record $6 billion that they had raised previously. As like I mentioned, they are targeting $7 billion for this fund. Given everything that firm has been able to do, just incredibly impressive. I would not be surprised if they even go above target here.
Yeah, I mean, $7 billion, honestly, for an infrastructure debt fund, it sounds big, but if you think about, again, we talked about infrastructure last week, how capital intensive these projects are. They need to get the capital somewhere. So I don't want to belabor the point. If you want to learn more about infrastructure, go to our podcast last week on infrastructure, but those projects are very capital intensive. They need not only equity, but debt as well to fund these projects. So there's plenty of opportunity for Brookfield to lend some big projects. Looks like they focus mainly on sort of data centers and renewable assets.
Yep. Well, great. That will wrap it up for us today. We have 2 upcoming events we want to call out. We will be doing Dakota Cocktails in Park City on March 20th. Maybe skiing will be a new sport for folks to be investing in.
Will not be me, but I encourage others to.
And then we will be in San Francisco on April 9th. You can check both those out. More information on the venues and the invites. Google Dakota Cocktails. And then we have our Dakota Research Conference. We're really, really excited about that. We have much more information coming for you all very soon, and official invites going out. Plan for that on June 17th in New York. We do the Dakota Research webinar on Thursdays. All of the information that we covered here today is covered in the Dakota Research webinar with a live demo. And that's actually all of the source for the data that we covered today. So you can check that out on Thursdays. You can sign up for that on our website as well. Otherwise, we'll be back next week, and we can't wait to hear from you all.
Awesome. Thanks for dialing in.
Thanks, everyone. Hello, everyone. Thank you so much for listening to the Private Fund News live show. All of the information we covered today and much more lives in Dakota Research, our private fund due diligence database. If you're not familiar with Dakota Research, we really encourage you to go onto our website and book a demo so you can check out all of the recordings, all of the data and information we covered, and much, much more. Again, thank you so much for listening in today. Go to our website and book a demo of Dakota Research today. Thanks.